Today, we are going to blow up an island, $415,378. That's a lot of money. So it begs the question, where do you put the money such that it is potentially tax-free? Delcetti Capital Management, LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Delcetti and its representatives are properly licensed or exempt from licensure. For additional information, visit www.delcetti.com with a hyphen between the L and the S. Hey folks, welcome to Season 1, Episode 3 of the Happiness in Retirement Program podcast, because the road to retirement should be an adventure, not a survival strategy. I'm your host, Bill Delcetti. You can find us on Spotify, Apple, or visit our website, www.delcetti.com to learn more with a hyphen between the L and the S in Delcetti. Today, we are going to blow up an island. And what I mean by that is we may shatter a paradigm that you probably have, you may have, or at least give you some insight that you may not have heard before. And then we're going to give you potential solutions to help you once we blow up that island, so to speak, and give you some advice, practical advice that you could take with you on your way on the road to retirement. So what exactly is the island we're going to blow up? Well, we're going to talk about compound interest. You may remember from grade school, the miracle of compound interest. Remember that? Probably, I don't know what grade it was, but we all learned about how compound interest is such a wonderful thing. And that's true, that compounding interest really can create a lot of wealth. And we've seen that with dividend reinvestment plans and interest in interest-bearing accounts. If you just set it and forget it and reinvest dividends or reinvest interest, you're getting not only that annual interest or dividend payment, but then you're getting interest on the interest if it's compounding and reinvested. Same with dividends. So you're getting paid dividends on top of the dividends that are reinvested. But what they don't teach you in grade school is that compound interest creates compound tax in a taxable account. So we're going to illustrate that today and give you some ideas about how you can still maybe get the benefit of compound interest or compounding dividends, but how to reduce the tax bill. And we're also going to introduce a concept called opportunity cost. And it's a concept that you're going to hear time and again on this podcast. Opportunity cost, or otherwise known as the cost of money, is the true cost of an economic decision. For instance, if you give $1 more to the government in tax than you have to, you don't lose just $1. You lose what you could have done with that dollar in terms of maybe investing it, not just for a year, but technically for infinity and perpetuity. Now, we can't measure that, but there is a true cost anytime we make an economic decision. And so we're going to measure that as well and throw that into the mix today in this conversation about compound interest and compound tax. So I'm going to start with an illustration. I'm going to share my screen and I'm going to go to my handy dandy LEAP calculator. LEAP is a tool. LEAP stands for Lifetime Economic Acceleration Process. It's a tool that some of us financial professionals use, but it has the best calculators I've ever seen to illustrate some points. So what I have on my screen now is a compound interest illustration. The assumption here is that there's a $500,000 account. The payment timing is end of year. Just simply means that the interest is earned but not paid until the end of the year. And the interest rate is 5% in this case. This could be dividends. It could be taxable interest in the form of a CD or a money market account. And for the time being, I'm going to assume a zero tax rate. And this is over 20 years. We could use 10, we could use 30, but this 500,000 is growing every year at 5% over 20 years. Now, again, this is a hypothetical illustration. I'm not trying to illustrate that you can get a 5% rate of interest. It's not investment advice, just simply to illustrate the point of compound interest. Ignore the cost of money for a minute. And we're going to come back to that. But I will say, actually, that the cost of money is what you could have done with the money or the highest after-tax rate of return you expect to earn over the long term. And so we use this to measure what a dollar could have done for us had we not gave it to the government in tax, right? If we pay more than we have to, not suggesting anything, you don't pay your tax. I'm just saying don't pay any more than you have to. But if you pay more than you have to, any of that money that goes to the government in the form of penalties, in the form of tax, in the form of interest that you pay to the government, you could have used that money to earn some after-tax rate of return. So I'm using 6% here. Again, we're going to circle back to that. But this is the miracle of compound interest that you learned in school. And basically, if you invest $500,000 into a taxable investment account and you're lucky enough to get a 5% rate of interest, then in your first year, you would have earned $25,000. Now, in year two, same 5% interest rate, but it's not on 500,000, it's on 525,000. So you're compounding, you're reinvesting that interest in the account, and therefore that interest is earning interest. So that extra 25,000 is also earning 5%. So in year two, the amount of interest you earn is $26,250. Year three, $27,563, et cetera, all the way down, such that in year 20, all the way down this column here, in year 20, the amount of interest that you earn is $63,174. So the amount of interest over 20 years, $826,649. So the ending account value, since your account value in this case, is $1,326,649. Well, this sounds great, except there is a potential problem here. So what is not reflected on your account statement is the amount of tax you pay on that interest. So if this is sitting in a taxable account, meaning a non-IRA, a non-Roth IRA, just a plain old brokerage account or a bank account, that is taxable to you every year. When you receive your 1099 with that amount of interest earned, you may look and go, well, this is wonderful. I mean, I just made 5%, it's 25,000 and it's compounding out. And it is a good thing. Except that when you pay your taxes, you don't write a check from the account for the taxes attributable to that account. Here's what I mean. So now we're going to inject into the conversation here a tax rate. And I'm going to use a combined federal and state tax rate of 30%, meaning 30% of what you earn goes to the government. I can use 20, I can use 40. I'm just using a number for illustrative purposes of 30%. So in year one, at the end of year one, you've earned that $25,000 on your $500,000 investment at 5%. You've earned $25,000, but the tax due on that $25,000 is $7,500. So that gets added to your tax return. You might not even realize that it's due to the account, but there it is. It's got to be paid. Year two, the compounding interest is great. So the interest in year two is $26,250, but that's created more tax, a compounding tax. So your tax bill in year two is $7,500, $7,875, and on and on and on, such that in year 20, yes, you earned $63,174 in interest, but your tax bill that year is $18,900. $952. So the reality of this is that the cumulative tax paid is $247,995. But because you didn't pay that out of the account, you don't really think about the fact that you paid this tax. So it's compounding out, just like the compounding interest. Well, it gets worse, my friends, because of the concept of opportunity cost. And opportunity cost is what you could have done with the tax dollars that you pay to the government if you kept it in your pocket. And it's the highest after-tax amount that you could earn. Now, I'm assuming here that, for instance, maybe your cost of money, what you could have done with the taxes if you didn't have to pay them, I'm just assuming that you put it into, say, a balanced investment portfolio with 60% stocks, 40% bonds, something like that. And the after-tax rate of return you could earn on that money is 6%. So at the end of the first year, there is no opportunity cost, okay, because you didn't pay that tax until the end of the year. But the next year, the tax and opportunity cost goes up to $15,825. And this is cumulative, by the way. Year 3, year 4, year 5, etc. So it's not only the tax that you lose, but the opportunity cost, what you could have earned on that tax that you paid. So at the end of 20 years, the tax and lost opportunity cost is $415,378. Now, I want to mention here, full disclosure, opportunity cost is a concept. It's real. It's very real, but it's still just a concept. If you don't invest those tax savings, then certainly that lost opportunity cost or the opportunity cost isn't there dollar-wise. But if you pay $7,500 more in tax like you did in year 1, then you necessarily had to, meaning you had other choices that didn't generate tax or maybe generated a lesser tax. And you used the tax savings to take a trip, to go out to dinner, to gift to your kids. Well, that's still a benefit. And we call that benefit that you derive, not from investing your money, but from enjoying your money. We call that psychic income. Kind of a crazy concept, but all it really means is you get to enjoy your money. And so whether you invest the money or spend it on something you enjoy, there's still an economic cost to paying more in tax than you have to. So that's the idea. Compound interest creates compound tax, creates lost opportunity costs in the taxes that you paid that you perhaps didn't have to. So now I'm going to go to a different screen. And so we're going to look at this from a different angle. And the different angle is a different calculator. And this calculator is called compound tax savings. So it looks very similar to the other calculators, saying $500,000, but now we have 2 accounts. We have account 1, it's taxable, and the interest rate earned on the $500,000 is the same 5%. It's over 20 years. And we have a second account. And the second account, I'm going to check this box that it's tax-free. Okay. So the same $500,000, but it's in an account that's tax-free. And so same situation, we're going to use a 30% tax rate, and we're going to use a 6% cost of money, what you could have done with the tax. So let's take a look at the difference. Here's the difference. Account 1, you pay that tax every year. Account 2, there is no tax. So that $25,000, you get to keep it all. So the tax savings in year 1, tax-free account versus taxable account, $7,500. Year 2, $15,825. Now look at this. This is a compounding out of the tax savings. So at the end of 20 years, having that $500,000 in a 5% interest bearing or dividend paying account versus a taxable account, it saves you a compounding. The tax savings is $415,378. That's a lot of money. It's a lot of money. So just simply, it's not quite so simple, right? But just simply maybe finding a way to create a more tax beneficial, more beneficial taxable investment or a tax-free investment. So now let's just take a look at flattening out the tax. So what if you every year you're still in a taxable account in this account one, but you take that taxable interest and you put it somewhere else that is tax-free, or you spend it. Okay. Now take a look at what happens. You're not creating a compound tax because you're taking that interest out of the account every year. You're taking it out. So it's not compounding and you're flattening the tax. So every year you earn $25,000, but that money comes out of the account and you either spend it or put it into some sort of tax-free investment. And so you flatten that tax out. So that at the end of 20 years, your taxes are $150,000. Okay, so the tax savings with a tax-free account, it's still there because you didn't pay $150,000 in tax in a tax-free account, if that's available. And the tax savings are $150,000. But when we add opportunity cost to that, it's $275,892. So anyway, point being though, if you just take that interest out, you're flattening the tax. So again, we'll look at just simply reinvesting that interest, the compound interest over the course of 20 years, $248,000 in tax, just by simply taking that $25,000 in interest earned out of the account. Now your tax is only $150,000 over 20 years. So one idea is just to take that interest out. Don't let it compound. Now, another strategy is to pay the account down. Now, paying the account down means that every single year, you're just taking money out of the account, including interest, such that by the end of the 20 years, there's nothing left in the account. Now, where's that money going? If there was a tax-free option available, then maybe that's where it's going. And if that's the case, by simply paying the account down, taking the interest and some of the principal out every year, such that by the end of 20 years, the balance is zero, then now your tax over 20 years is only $90,728. So again, if you don't do anything, if you just compound out the interest, you just reinvest it, you're going to pay $248,000 in tax over 20 years. Option two, just take the interest out of the account every year. Don't let it be reinvested. Now your tax is $150,000 over 20 years. And then finally, if you pay the account down over 20 years, now your tax is $90,000. So it begs the question, well, where do you put the money such that it is potentially tax-free? Well, the first thing that comes to mind is maybe using some of the money, if it is possible, to fund Roth IRAs. And so if you're married, maybe if you meet the requirements to fund Roth IRAs, which are simply tax-free investment accounts, then take some of that interest and invest it in Roth IRAs. Now, you may not meet the requirements to do that. You may be retired. And if you're retired and not earning any income, then you can't make Roth IRA contributions every year. Or you may be over the income limit to invest in Roth IRAs. A second option is if you are working to invest in a Roth 401k. And simply what you would do is take this taxable money, use some of it to live on, and correspondingly in your 401k, if you're not already investing the maximum, then you're going to take the corresponding same amount and get yourself up to the maximum 401k contribution in Roth. So on the one hand, you're taking money out of the taxable account. Remember, you're flattening that tax or doing a pay down. So you're not creating a compound tax. You're actually reducing that tax year over year and simultaneously having more money come out of your paycheck to fund the Roth 401k. So it's kind of not necessarily a shell game, but you get the point, right? So instead of using your paycheck to live on, you're investing more in Roth to get that tax-free investment. And then you're simultaneously drawing down a taxable account to live on. So that's another option. If you can't do either of those, then if you're retired, for instance, maybe a Roth conversion, taking some of an IRA that you have, tax deferred account, and converting it to Roth and using the taxable account to pay the tax. So every year you convert some amount of money to Roth IRA. A Roth conversion is just simply taking money in an IRA that ultimately is tax deferred and ultimately taxable, converting it to Roth. When you do that, you pay the tax on that conversion on your tax return, but you use the money in the taxable account to pay the tax. So you're spending down either the interest or the interest in some of the principal to convert more money to Roth. Now, again, that could be another entire podcast if we were to talk about it. What are some other options that are available to you? Well, what if you're in a situation where you've got plenty of money, more than enough to live on comfortably the rest of your life? Well, you could just simply gift every year, right? Out of the taxable account. You could just simply gift to the kids every single year. And when that money is out of your name, you're not paying tax on it anymore. So that's another way to flatten the tax or reduce the tax in the taxable account created by compounding interest, simply gifting, creating a gifting strategy. Or you could just simply gift to charity. Now, without getting into the details about gifting to charity so much, it generally makes more sense to gift appreciated securities instead of gifting cash. Again, the subject of another podcast. But hopefully you get the point, folks. And the point is that compounding interest in a taxable account can create a compounding tax in an interest-bearing account. So there are some strategies and tools you might be able to use to pay less in tax, use those tax savings, invest that money and earn more money, reduce that opportunity cost, and keep more money in your pocket, or simply enjoy it. Instead of giving that money to the government in the form of the tax, give it to your kids or put it in a Roth for the kids, gift it to the kids and they can fund it Roth. So there are solutions. So hopefully you learned something new today about compounding interest and the creation of a compounding tax. If you have any questions, reach out. Tune in to our episode next week. Every week, every Sunday at 8 a.m., a new episode drops. So look for that. Again, subscribe on Apple, Spotify, or www.thelcity.com with a hyphen between the L and the S. Hope to see you next week. Bye-bye.